It's one of the biggest questions that's going to face markets in the next 12 months and beyond. Will tighter policy have the reverse effect of what loose policy seems to have? It's really simple. You can draw a chart, global big five central banks, aggregate balance sheets against the FTSE All World, and they match each other perfectly. And central banks intentionally said, we will try and create a wealth effect by inflating asset prices. So surely it seems logical to expect the risk, at least, that if they start to take liquidity away, you could get valuations start to fall. To avoid that, underlying growth has to be strong, underlying corporate profits have to be strong, then we've got a very good chance of coming through the other side. But certainly there is the danger that taking away that liquidity provides a very big challenge. I think the key risk at the moment is that everybody's quite relaxed and happy with life, quite frankly. If you look at the VIX index, the fear index, it's at record lows. So that at the moment, the feeling is all's good, thank you very much. But the last time we've seen the VIX at this low for this long, accidents followed the Asian debt crisis, the global financial crisis, the bursting of the TMT bubble. So complacency tends to breed problems and misallocation of capital. Other risks, central banks withdrawing liquidity is one potentially. There's always the risk of a bad loan crisis popping up in China or Europe, unlikely as it seems at the moment. Oil price shock, there are lots and lots of risks. None of them seem likely at the moment, but that's why we all need to be on our guard for that black swan, because at some stage, one probably will sail into view. Valuation is fundamental. Price is what you pay and value is what you get. And so in the end, it's the ultimate arbiter of the return you make from any investment. Looking at any way you slice it, it's tough to make the US look cheap. It's not that easy to make the UK look cheap other than on dividend yield relative to bonds. So if UK dividends stay where they are or keep growing, that's a good sign. What you wouldn't want is inflation going up, because that would drag bond yields up and the gap would close. So on earnings, the UK is not cheap. Dividend yield it is. If there is value out there, it's in emerging markets. Price to book value of about 1.4, 1.5 times. Not too far from the historic average, but when emerging markets really fly, that multiple goes up to 2.5 or more. So you're looking at a level here where historically, and I admit history is no guide, you've potentially made 40 or 50% from here when things have gone well. So if there is value to be had, it's probably emerging market equities right now.